Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax-efficient or tax-free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no-cost, no-obligation consultation with me. Enjoy.
Good morning. Good morning, everybody. It is November 16th, 2021, and it's almost 10 o'clock, 9:59. It's time for our weekly webinar. We're going to have what seems to be a big crowd today. We have over 112 people registered for this webinar this morning. So I appreciate, how much this has grown for sure. And I appreciate those of you who are here every week. There's many clients who join us every single week. And I appreciate that because, it makes our job easier when you stay educated. There's so much that we do differently than most that sometimes it's easy to fall back in the old paradigms. Many of you, have gone through the Changing World of Retirement classes or read the books, the Power of Zero, the Retirement Time Bomb from Ed Slott, and Power of Zero from David McKnight, and the Tax-Free Income for Life from David McKnight. So, you forget these things sometimes, and it's easy to slip back in the old ways. That kind of got us where we are today. So we want to proudly think differently than most folks, and be on that different path. But it is easy to come back. And so when you attend these webinars and you stay informed, it really helps us as well. So I appreciate it on so many levels. As always, I appreciate those of you who bring your friends and loved ones as an introduction into the firm. We'll always make room for those close to you. As you know, we've dampened, slowed down the amount of clients that we take on a regular basis, but we'll always make room for those close to you. All right, so let's get started. Today, just like every day, every webinar day, we're going to go over some slot updates. So I read the slot mailbag, and usually the update we get, most of you find that helpful. Again, that's just remembering why we do this and the mechanisms that we use to do it. Then I'll talk about the markets, and then we'll talk about our financial planning topic for today, and that is the Medicare increase, right? And I've got a lot to say about that. So let's dig into it. So just want to remind you that you are muted. There is a Q&A at the bottom of your screen there. You can type in a question. Please do so as we go along. Your chat is disabled, and you are being recorded, and I hope you're catching these recordings online as well when you can't make it. So we talked about there is a big Medicare cost increase for 2022. You may have seen it. I guess the first publication I saw was on Friday that talked about it. So I've got a little bit of a CNN article. The infrastructure bill you may have seen was signed into law yesterday. So that's $550 billion in new federal investments in America's infrastructure over 5 years. So that touches on everything: bridges and roads, broadband, water and energy. So of course the folks who are behind it are saying we can do all this without any tax increases. And the Congressional Budget Office says that doesn't add up. Ultimately, the Congressional Budget Office says ultimately finding the package would add $256 billion to the deficit over the next 10 years. So I'm always concerned about that. We have so many headwinds from an increased tax point of view. So I don't see how this won't increase taxes as well, but I hope I'm wrong. So the CPI numbers also came out. So Consumer Price Index, they came out last week. And we saw another big increase. So nationwide, it was 6.2%. So this comes from the Bureau of Labor Statistics. You may have heard this already. I think it was 5.9% last month. So year over year, when they're talking about these numbers, they look back. So we're in October of 2020 to October of 2021. Now, of course, we're still in the middle of we're still technically in the middle, I guess, of this global pandemic, but we're right still in the heat of it, even in the fall of last year, if you remember. So nationally, we're at 6.2. Locally here in the Mid-Atlantic region, we're at 5.6. These are big numbers. Now, as we go into some of the analyst reports, when I talk about the markets, I also go through some analyst reports that I read and give you my interpretation or my thoughts on it. But some folks think this is much ado about nothing. But these also are significant headwinds. So I just want you to start lining them up for me. So $256 billion added to the federal deficit that's already out of control. Higher inflation over the next X number of years. So is it going to balance out at some point? I'm certain it will. It's not going to be 6.2% over the next 30 years. That's something that we just can't keep up with for sure. But it's been certainly low for a good number of years, more than a decade. So could we see this higher inflation number for the next 10 years? We might. We already see that people's habits are changing because of the cost of things. Gasoline, for example, food. I used the example a week or two ago that I did a barbecue for a group of my friends, and I made a brisket. Another person made her smoked ribs, and but I paid more for that brisket than I had ever. Still worth it, but as long as you can, right? That's the thing. All right, and we'll come back to the article. And CNN as U.S. announces a big hike at Medicare premium. So we'll come back to that in some more detail in the financial planning discussion. But let's go into the slot report. So the first is from Sarah Brenner, and this came out on November 15th, and this is a notification. And we've all heard this already, but I'll just give you the numbers. So these are for retirement plan contributions, 401k contributions. So 401k contributions in 2022, they've raised the limits. So for 401ks, thrift savings plans, as long as also 403bs and 457 plans. So typical retirement plans. That is for a single filer, the contribution level, the most you can contribute. Now, a lot of people say, well, my plan will only let me contribute 10%. Plans can be more restrictive, but there aren't a lot of those anymore. So what do I mean by that? If you earn $60,000 a year, then your plan says you can only earn 10 or contribute 10%. That would only be $6,000 a year. Most people, when they say that, they're incorrect. Most plans follow the IRS guidelines, and the IRS guideline says if you're a single filer this year, you can contribute $19,500, your own contribution. This isn't the matching contribution. Next year, 2022, it's going to be $20,500. Excuse me. If you're 50 or older, you have a catch-up contribution of $6,500. That didn't increase, but the baseline increased. So you can go up and contribute $27,000 a year, and if it's available to you, you should, and it makes sense for you, you should consider investing that into a Roth 401k. So remember, the benefit of the Roth 401k is there are no income limitations, right? With the Roth IRA, there are these phase-out levels. With the Roth 401k, we don't have that. The capital and the compensation that can take into account for calculating retirement plan contributions is increased from $290,000 to $305,000. So SEP IRA contributions went up, $58,000 to $61,000. Simple IRA contributions increased as well, going from $13,000 to $14,000. And listen, folks, if you, depending on your situation, SEPs can work for you. But if you're doing a simple, you should look at doing a 401k. Most people do simple retirement plans as a replacement for a 401k because they think it's easier, less administration costs. That may have been the rule several years ago, but you can contribute just so much more in an IRA a 401k, and you also have Roth options. You just have a lot more flexibility, and simples, in my opinion, just almost don't make sense anymore. So the IRA individual retirement account contribution limits are going to stay the same though for the fourth year in a row at $6,000. The $1,000 catch-up contribution also is not indexed for inflation, so that's $7,000 for an IRA, traditional IRA, or a Roth IRA if you're able to make contributions. So the phase-out range for now did increase the phase-out ranges. The phase-out range for Roth IRAs for single filers is now 129,000, 144,000, up from 125 to 140. And all these charts will be updated. The charts on my website will be updated as soon as they're available. They're not quite available yet. I'm waiting for them from the Slott Group, but once they're available, we'll get them updated. So this will be a little easier to follow. So some things have gone up. The IRAs have not gone up, but the phase-out levels have increased. Let me just say that. There are also increase in limits for if you're participants in a qualified plan, that you can make a deductible traditional IRA contribution or do a Roth contribution. So so if you have questions about that, reach out to me and we can talk about your situation. So going into the mailbag, so they have the Slott Report mailbag. These I thought were interesting because these are common questions that we hear all the time. And this is how people get things turned around. I was talking to a fellow who's quite astute in his investments, and he talked about, he was telling me that he had until April 15th of next year to make his Roth conversion happen. And I reminded him that that's not the case. They have to be done by December 31st. Or at least all the traditional IRA money has to be out of the account by December 31st for it to count as a 2021 Roth conversion. So it's easy to get these things spun around. And as you've heard from me in the past, custodians might have completely different rules. Our custodian, Fidelity National Financial Services, has a deadline of, I think, the day before Thanksgiving this year. So they moved everything up. If you're a client, you know that because we suddenly had to put the gas on and get these things done for you. So this question is about calculating your RMDs and Roth conversions. So this first question, when calculating my required minimum distribution amount, is my Roth IRA balance added to my traditional IRA balance? That's a good question. We always say you got to calculate your IRA balance at the end of the year. You divide it by the value that you're given on your life expectancy chart that you can find on the website, and then that tells you how much you have to take. This person's asking, well, wait a minute. I know I don't have to take a distribution from my Roth, right? A required minimum distribution. No required minimum distributions in a Roth IRA. That's another reason they're so valuable. Traditional IRAs, they force you to take the money out even if you don't need it, and you have to pay tax on that. We know what the tax rates are today, but we don't know what they're going to be in 5 or 10 years. I understand I have to withdraw from my Roth, but we just want to know how RMDs are calculated. So does he have to calculate all of his IRAs, including the Roth IRAs? Actually, a good question. So the answer is, when calculating your RMD, required minimum distribution, only the traditional IRA balances of 12/31 of the previous year is included. Your Roth IRA is a separate entity and has no bearing on your traditional IRA, RMD. A lot of initials. If you have multiple traditional IRAs, each IRA must calculate its own RMD, but the total RMD amount can be aggregated and taken from one or more of your traditional IRAs. So of course that makes sense. The Roth IRAs stand on their own, and they're not required. You don't have to take distributions from them, so they're not part of the calculation. Andy goes on to say that you have to calculate each RMD on its own, but you can take the IRA RMDs as an aggregate. Now, remember, retirement plans and IRAs have different rules. You can take an aggregated amount. What does that mean? You have $1 million in your aggregate, your total IRAs, and your distribution for the year is $40,000. Yes, you can take it from one of those IRAs. If you have $1 million between your 401ks and your IRAs, can you take that $40,000 just from your IRA and satisfy the required minimum distribution for your 401k? No, they're separate. You will get caught up in this deficit of required minimum distributions that's going to be very, very costly for you. So you can aggregate IRAs, you cannot aggregate retirement plan assets, so 401ks, etc. The next question, I was recently transferred from a federal thrift savings plan, TSP, retirement account to a traditional IRA? Is it possible in the same year to convert to a Roth IRA? Really, another great question. So 2021, he rolled over from a TSP, thrift savings plan for federal government, to a retirement account and a traditional IRA. So this could really be the same for anybody, right? Can I roll over my 401k into an IRA and then do a conversion in the same year, or do I have to wait? The answer, of course, is yes. In the same year, you convert all or a portion of your IRA dollars that rolled over from the thrift savings plan. Neither the direct rollover from the thrift savings plan to the IRA nor the Roth conversion will count against the one rollover per year rule. So no worries there. Be aware that these transactions will generate a string of tax forms. But when netted together and reported properly, the IRS will see what happened. And he goes on to give an example. For example, the thrift savings plan will issue a 1099-R showing that the plan money leaving. So they issue a kind of a ticket as the money goes out. The custodian, say you roll it over to us here, and the custodian is Fidelity, then that custodian issues a Form 5498. Now you have that matched up. Well, $1 million comes out of the thrift savings plan, $1 million comes into Fidelity. That makes sense. So the IRS sees that matches up. For the Roth conversion, it's the same thing. The custodian is going to issue a 1099-R and then also report the transaction on a Form 5498. So you need these forms to balance. I caution anybody who's doing Roth conversions, please don't try to do this yourself. Please have a qualified CPA help you with this. You've heard me talk about your team. You should have a qualified certified financial planner. You should have a qualified certified public accountant, CPA, certified public accountant. Yeah, CPA, and a good attorney, right? At least one. So that's the team you want working for you. It's very valuable. The clients of ours who have this team working for you, you understand it, you get it. All right. Now we're going to go into a bit of market updates. So, the markets were down last week. I got to make this a little larger. Markets were down last week. The Dow Jones Industrial Average was down just over 0.5%, 0.56. Still up for the year, 19.79%. So if the year ended today and you were just invested in the Dow Jones Industrial Average, I think most people would be happy with that. Frankly, I think most investors, if we ended things where we are right now, would be very, very happy where they are right now. The S&P 500 was down 0.27%. The NASDAQ was down 0.68%. So very much across the board. There are a couple indices that were up slightly, but very much across the board, everything. Actually, it just looks like one that I see here. Even the bond market. So the stock markets were down last week and the bond markets were down last week. So the bond markets, the Barclays Aggregate Bond Index, which is probably the broadest one people use, is down almost, 0.75%, 0.75, and is down 1.69 for the year. So not a good year to be offsetting the risk of bonds with stocks, right? Or, excuse me, that is good, actually. That would have worked out good because the stock market, not a good year to be offsetting the risk of stocks with bonds. So that works well. All right, so let's talk about BlackRock. What's BlackRock talking about? So BlackRock's one of the largest money managers, and they have a great analytical team. Their analysts are top notch. Their inflation they're talking about is top of mind. So inflation's back in the discussion, right? The CPI just came back with big numbers, 6.2%. That's consumer price index. And now these analysts are talking about it. BlackRock says we see pressures, price pressures, that's inflation, mostly to persist in 2022, mostly driven by unusual restart dynamics. It's hard to open back up after a pandemic is what that means. People are still not working, right? I picked up my daughter from dance yesterday. She wanted to get something to eat. IHOP was closed. She wanted to go to IHOP. IHOP was closed. We stopped at the local diner on the way home. The diner had to shut down at 8:30 because they didn't have enough staff. My daughter said, I thought these diners ran like 24/7. Aren't they open late? And it's just everybody's kind of dealing with it, right? With shortage of staff. So, supply line issues, we're hearing about that endlessly. And so, it's difficult to reopen and get people jump started to free things back up. I don't know if we anticipated how difficult this would be. So we talked about the consumer price index increasing 6.2%. BlackRock mentioned that. They talked about data from China this week, expected to show a further slowdown in economic activity. And they generally said inflation was at the heart of the debates among BlackRock portfolio managers at our 2022 Outlook Forum last week. Inflation is being driven by the unusual supply shocks tied to the restart. We expect these imbalances to resolve over the next year. I hope so. But see inflation as persistent and settling at a higher level than pre-COVID. Okay, so I don't know how it doesn't. So pre-COVID, it was quite low. Inflation has been low for, as I said, a decade or so. I think what they're saying is we're likely to see it settle at around 2, 3, maybe even 4% on average for a while. We prefer such equities. We prefer equities in such an environment. Equities are stocks. So they're saying they're investing in stocks in an inflationary environment. As we expect a more muted yield response to inflation than in the past, this should keep real yields low, supporting stocks. So they're bullish. They're liking having stocks overweighted in their portfolios. BlackRock is a tactical manager. That means they make changes based on where they see the markets going. That can be okay from a manager point of view. I don't agree with it from a portfolio management, overall portfolio point of view, but it can work well for certain parts of it. Riverfront also talking about inflation. Global supply chains are currently clogged up. Anybody who's watching the news knows that. We think it'll be mid to late 2022 before things return to normal. Again, very optimistic. I like to see some optimism. I just hope it works out. Because we think inflation will be transitory, we remain overweight in stocks. So they're overweighting stocks as well. So who knows? Could be a good year for stocks, right? So how do you address these issues? We always talk about this. Asset allocation. Make sure you've got your allocations in place, principal protection, account segmentation, and some area of guaranteed income, if that makes sense for you. So those 3 pillars for sure: asset allocation, principal protection, and account segmentation. This is the foundation I'm always talking about. You want to build that foundation so when things get rocky, remember the buildings in San Francisco, when things get rocky, that you might have some cracks, but you're not going to crumble. So very, very important. Okay. Let's talk about, let me throw up my whiteboard here. I'm going to move things around just a second. Okay, so just raise your hand for me if you can see the whiteboard. All right, excellent. Thank you. All right, so this is maybe you saw it already. There was a CNN article on Saturday that came out, and the headline was "U.S. announces big hike in Medicare premiums." So that's a startling article, right? Many of you are just starting to collect Medicare. We've had a lot of discussions about this IRMAA, income-related monthly adjustment amount. Next week, I'm going to devote the financial planning portion of this webinar to IRMAA and Roth conversions. And there are some things that Roth conversions drive up, well, most things. When you convert funds from a traditional IRA to a Roth IRA, you increase your taxable income, you increase your adjusted gross income, you increase your modified adjusted gross income. The only thing that a Roth conversion doesn't affect from an income point of view is the ability to make Roth IRA contributions. So if you're below the threshold from all your other income for Roth IRA contributions, but you can, and you do a $100,000 conversion. I talked about this a few weeks ago, and you think that that's going to knock out the ability to make the contribution. That's not true. You can still contribute. There's a clause that allows that to be separated, but everything else increases these things, including IRMAA. IRMAA, income-related monthly adjustment amount. That's the kind of the tax that you pay for having higher income, and you pay more for your Medicare premiums because of that, your Part B premiums. So this is the kind of fringe tax increases that I've been talking about. This is where you're seeing, you've already seen it beginning, but you're going to really see some action by the federal government because they know that things are going to be bad very quickly, and the lines are getting much closer. We're going to talk about the Social Security and Medicare trustees report again. I have a chart to show you down here, but actions are going to be taken, and this one was pretty significant. So there's a 14.5% price increase for Part B premiums. So what this year in 2021 is $148.50 a month this year will be $170.10 in 2022. So if you don't know, Part B covers physician services, outpatient hospital services, certain home health services, medical equipment, and certain other medical and health services not covered by Medicare Part A, including medication given in doctor's offices. And that's one of the areas that they're concerned about, is the higher cost of special medications for Alzheimer's patients. This Alzheimer's, dementia, long-term care is a significant problem. We all know that. If you've worked with us, if you've gone through the financial planning process, we spend a lot of time on this. A retired couple has more than a 70% chance that one of you is going to need long-term care at some point in the future. And the numbers are staggering. So it's been a few years now. So I'm guessing the number is a little higher, but you've probably heard me say that I was attending an insurance continuing education class, and the presenter from one of the large insurance companies said that the average claim period for dementia is 8.2 years. So what does that mean? That means that on average in the US, if you have dementia, you're receiving benefits, and you have insurance, you're receiving benefits for 8.2 years. That's a long time. And if you think about those costs that can be involved in long-term care, $100,000 a year, $150,000 a year, sometimes close to $200,000 a year, depending on your situation. My goodness, how long can anybody sustain that? So these are the things that, of course, everybody's paying attention to, including the federal government. Medical costs are very, very high. Now, somebody is always going to say, well, somebody's going to fix it. Well, I don't know who the heck's going to fix it. It's going to take a miracle coming out of Washington, in my opinion, but we're going to have to pay for it for sure. So this is a really important notice that this is a really strong first step. That listen, we gave you 5.9% in Social Security, and it actually references that in the article. It says basically people who are paying through their Medicare, because not everybody pays for their Medicare through Social Security. Some people wait to claim their Social Security, but they said the cost of living adjustment of 5.9% will just about cover, or you'll actually see it still see more in your Social Security check. So they give it to you, they take it right away. And that's the largest bump in 30 years. And of course, they increased Medicare for the largest amount. And I think that was 30 years as well. So it's starting to happen. It's important to position yourself so that you are not in the way of these things happening. So how do you do that? Well, you can, here's the 2022. Let me bring this up. For comparison, let me show you. So I'm going on my website. I'm just going to pull this over. So this is the 2021 Medicare chart. So as soon as we get a new one of these, I'll make this a little larger. As soon as we get a new one of these for 2022, I'll post it on the website. But here's what I'm talking about. So we have the basic cost, $170.10 starting in 22, which is now $140. See this? And 50 cents. Now you have these brackets, right? These income brackets for IRMAA. 88,000 to 110,000 is a single filer, and 176,000 to 222,000. You pay a surcharge, $59.40. Your total premium for Part B goes up to $207.90. If you have drug coverage, it goes up a little bit more. So, and as you increase, you'll see here, I hope you can see my cursor. Well, the surcharges become more, so your total amount becomes more, and it can be as high as $5.04, $504.90 per individual. So if you're a married couple, yes, of course, you're paying more than $1,000 a month. I don't see people go over this area much, but we have a lot of people that live in this space as a married couple. And here's why this planning is so important, because you'll see here, just like your tax brackets, the single filer really gets crushed very quickly. And is it hard to believe that during retirement, you're going to have levels like this, with pensions, Social Security, required minimum distributions? Well, you might at least hit this, but remember that you're very, very unlikely to leave this earth together. And there is a significant financial penalty to being single, whether you're in retirement or out of retirement, but I would say certainly in retirement, because these numbers get cut in half, right? So I hope you're hearing that, because the planning portion of this is so important, because we're going to see increases like this, very likely from the federal government, right? Just not modest increases, but a 14.5% increase of Medicare. We're going to see increases in IRMAA. Let's look at what the increase is for 2022. So remember these numbers, 88,000 and 176,000 is where they start. Now, these are adjusted for inflation. IRMAA wasn't adjusted for inflation until 2020, but now they're adjusted for inflation. So now these numbers are $91,000 to $182,000. So you get a little bit of juice there. But if you're married now, live in these brackets as long as you can, because it's not going to last forever. So just like tax brackets, you want to spend, get as much as you can get done there. So let me pause there for a second, because I do have a question. So let's see what the question is. Yeah, okay. All Walter mentions, IRMAA is applied with a 2-year look back. Does this mean that I lock in my 2024 increases in 2022 and pay in 2024 dollars? Yeah, you can. So it is a 2-year look back, and that's a good point. So what you're doing in 2022, what your income is in 2022, you're going to be assessed for in 2024. So when we're doing our financial plans and we're counting for IRMAA, we're doing our wealth conversions, and I'm kind of going into the conversation for next week, but that's okay. And we're accounting for IRMAA. There's an overhang. So if if all your conversions are set to be finished in 2025, let's just say, we overhang. IRMAA continues to pay for 2026 and 2027. So I think that Walter's, that's what he's asking. But does this mean that I lock in my 2024 increase in 2022 and then pay with 2024 dollars? So the interesting thing about that is that if inflation continues to chug along at 6%, 5%, or 4%, your 2024 dollars are going to be worth less than your 2022 dollars, right? Because of the value of your currency goes down as inflation goes up. So there's an additional cost built in there. That's something I hadn't considered, Walter, but as soon as I read your question, and I don't know if that's what you were going for, but that at least sparked that thought in my mind, because everything costs more. As we, again, when we do our plans, if someone says to me, I need to spend $10,000 a month in retirement, that's $120,000 a year. Very quickly, because of inflation, that looks like $150,000 a year just to keep pace with what you want to do today. So you have erosion of your dollars, and you have increase in costs. Now, let's hope that the federal government continues, right? And I think they will, but I hope they'll continue to index, right, and increase these IRMAA tables with inflation. But that is one way they could collect. I hope nobody's listening in Congress, but that is one way they collect more Medicare dollars, is to stop indexing these IRMAA rates, because more and more people will be caught in it every year, just like the alternative minimum tax a few years ago. And so I don't want this to sound dire. I don't want it to sound alarming, but it's something you should be paying attention to and actively working on. Especially in this past year, I've had clients who said, well, I understand I have to do conversions, but I want to stay below, this $182,000 IRMAA level, or this $228,000 level. And we'll talk about that next week, but there has to be a benefit to that other than just, this makes me uncomfortable paying this premium. Now, I understand that there is, to have a successful financial plan, you have to be comfortable in it. You have to have confidence in it. But when the math shows that over your lifetime, you're saving $50,000, $60,000, $100,000 by paying these payments early, because they're not going to go away, then that's the right thing to do mathematically. Now, getting behind it emotionally is a completely different story, and that's something we continue to work on for people. So you've got to pull all these things together. I'll tell you, as I coach other planners who are getting into this space, this tax efficient planning space, IRMAA is often missed until it hits a client. So I worked with a client, or with an advisor a couple of years ago, and we were working through what financial plan he did. And I said, you're missing the IRMAA calculations here. He said, the plan accounts for it. I said, no, it doesn't. It accounts for a Medicare tax, which is completely different, but it does not account for IRMAA. So it's something a planner has to build in to most plans. I haven't seen a tool yet that automatically calculates that IRMAA calculation, because it is very, it's different for everybody, of course, depending on where you fall in those brackets. So again, why is this so dire? I just want to remind you, and I included this as well because I think it's always important. So we talked about headwinds, right? We've got this now. Medicare jumps 14.5%, well over the 5.9% cost of living adjustment for Social Security, which we all thought was, wow, that's really big. But trying to keep up with inflation. Think about the poor individuals going into retirement that think that they can do this in retirement with just investing in CDs and living off the interest. Well, CDs are paying nothing. So you have to take risks in the markets. Where do you take risks? And if your inflation's at 6.2% and your Social Security is at 5.9 and your CD's at 1%, let's just say you're knocking it out of the park and you're getting a 2% CD. Well, after you pay tax on that CD, it's maybe earning you, 1.5% or maybe less, and you're underwater, right? If things are costing 6% more and you're only earning 1%, 1.5%, then you have a 4.5% loss or a 4% loss. I know that's a lot of numbers I'm throwing at you, but that's how you have to look at things. So you need to be safe and productive, and you need to have that balance. And the only way from an investment perspective to really succeed in it is to have that mix. And my belief, asset allocation, principal protection, and account segmentation, that's the answer to it. But let's look at this. This is from the Social Security and Medicare Trust Fund report that comes out every year. Most recent one came out in August of this year, 2021. So what is this telling us here? Let's focus just on this bottom. I don't know if I have a pointer here. They changed my whiteboard structure last week. I jumped on a webinar or a meeting with a client, and suddenly everything was different. So I'm kind of don't know where my stuff is. But let's just look here. I'll just use my pointer. The year trust funds are depleted. So this is Social Security here. Old age insurance, old age. I forget what the S is for now off the top of my head. But that trust fund is scheduled to be depleted in 2033. So what does that mean for us? So in 2033, only 76% of the benefit can be paid starting in 2023 of Social Security. So that's not acceptable, right? You're not going to take 70. Thank you, survivor. Thank you, old age survivor insurance, Walter. Thank you. I need to put Walter on a retainer and just have him be a co-host or something like that. He's always given me great information like that. But at that time, in 2033, only 76% of the benefits are available to pay for your Social Security. Or they can only pay 76% of your benefit. Who's going to accept that? That is not acceptable. Something has to be done before that. Medicare. So if I go to this is Medicare, right? HI, hospitalization insurance, I think it is, Walter, off the top of my head, but you'll tell me. That's set to be depleted in 2026. So 2033 can still feel far away. 2026 is, right around the corner. Christmas is here. Before you know it, 2026 is just going to be here. And the Social Security timeline for that runs out of funds was reduced a year. So it was scheduled last time on the trustees report, it was scheduled to be 2034. Now it's 2033. This stayed the same. Medicare stayed the same. But we lost 3 years and 1 year in Medicare, right? So it was 2029, it was 2030, and now so disability. Thank you. No. Hospitalization. I'm talking about this is disability, Walter. I'm talking about Medicare. That's okay. So 2026 is now when that's set to run out of funds. So And what that means is Medicare will only be able to pay 91% of the benefits. Now, that sounds much better than 76%, right? But 91%, you're still not going to accept that. I want all of my Medicare benefits. So something has to be done with that. This is where sometimes people say to me, well, Congress isn't going to do anything. Well, they have to do something because the American public isn't going to accept this. Now, my generation, let's just say, we might say, you know what, if you wanted to reschedule our Social Security to the earliest collection age is, let's say 70. If I wait until I'm 72, I'm at my full retirement age. And if I wait until 76, I get the maximum amount. I think that could be something that could be worked out. It'd be acceptable to me, probably be acceptable to many folks. I don't know. But just saying we can't pay the full benefit is not acceptable. So all these things are colliding. And you've seen me do the intersecting lines discussion, where we have revenues declining and expenses increasing, right? So revenues declining, expenses increasing. And just speaking about Social Security and Medicare, we've got these data points, right, that we just talked about here. So 2023, 2026, we're starting to now see when people say, well, what the heck are they going to do? And I've got they can print money, they can raise taxes, they can cut expenses. They're not cutting expenses. Let's just give up that, right? Nobody's going to cut expenses in Washington. It just doesn't seem to be in anybody's playbook there. So where does this action step happen? Because here, this is when we can't pay our bills. I don't know when that is, right? So we're talking, add the national debt into there, totally out of control now. This infrastructure bill, the Congressional Budget Office, I think it was $256 billion. It's going to add over the next 10 years, and it's already out of control. So it's like having your own personal debt that you can't pay, and you just bought a shore house and additional debt, and that doesn't make sense. So you've seen this before, right? This is Medicare. This is Social Security. When does Congress act? When do they step in? And I would argue that here we are. They're starting to step in. They're starting to take action. So you're going to see more things. That window that we've talked about to do things, and that is move to tax efficient vehicles, is closing very, very quickly. So next week, we're going to talk about IRMAA and Roth conversions. I'm going to show you some sample comparisons of the cost of IRMAA, without it being inflated, and the cost, if you pay it over your lifetime, or you kind of front load it with your Roth conversions, and we're going to go through and that's a decision everybody has to make on their own. But these are actions that you have to take because Congress is taking action, Washington is taking action, and it's just by need, right? We have to do something. We can't. People will say, well, they're just going to kick it. They're going to kick the can down the road like they always do, but at some point they can't. And I think what we saw over the weekend is a key indicator that it's time to pay the piper, and it's going to start. It's going to start slowly. If you call 14.5% increase slow. This is what else I think is very impactful about this is that this hits the folks who are collecting Medicare. I think most people thought that there would be an increase in payroll tax, right? But this hits the cost of Medicare and the folks on it. Okay, we're just about at 10:45. Let's just see if there's any other questions. Walter, I appreciate all your answers and commentary there. I appreciate everybody who attended today. If you need to see me, my calendar is going to pop up. I don't know how much time is left on there before the end of the year. If you haven't done your Roth conversion, whether you're a client of ours or not, and you're waiting for something, there's no waiting to be done anymore, right? We have some deadlines. I think we've got everybody covered, or we're wrapping up the few people we don't get covered. But if this is something you're trying to do on your own, don't mess around. Certainly, you can't wait until April 14th or April 15th. You have to get it done by 12/31, and you don't push it that closely. All the custodians, because this is becoming a more popular strategy as more people are jumping on board here, which is a really good thing. And custodians are getting overwhelmed with year-end paperwork. So pay attention to deadlines, get the work done, and get out of the way. Get out of the way of this. We're starting to see it. It's certainly right on our doorstep. So pay attention and get the work done. All right. Next week, again, we're going to talk about IRMAA and Roth conversions. We're going to go over our market updates. We're going to have some new slot information. And that's it, folks. Have a great week, and I'll see you soon. Take care.
Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.